In comparison to sole traders and partnerships, a private limited company is owned by its shareholders, who are typically the directors of the business, and shares cannot be offered to the general public. You may also see a private limited company with the abbreviation LTD after their name. And a private limited company is an incorporated business, which means that the business is actually classed as a company and has its own separate legal entity in the eyes of the law. Therefore, the ownership of a limited company is divided up into equal parts called shares, and the owners are now classed as shareholders. This is a completely different structure to sole traders and partnerships that we've just looked at. Unlike a sole trader or partnership, the owners of a limited company are not necessarily involved in the running of the business, unless they have been elected to the board of directors. Common examples of private limited companies are local retailers such as high street shops or restaurants that do not have a national presence. Mars Inc. is also a famous example of a private limited company. Although they have a huge worldwide presence, they've chosen not to go public to ensure they retain the family values of the business and fear these would be lost if they operated as a public limited company. This is also the same scenario at Dyson. Importantly, the term limited in private limited company means that all the debt of the business is separate from the individual shareholders. Therefore, they are not personally liable and won't lose their personal assets should the business suffer from financial hardship. Another key advantage of being a private limited company is that it's much more tax efficient than a sole trader or partnership business model. However, whilst the owners hold shares in the company, the assets and any profits that are generated also belong to the company. Therefore, getting paid can be more complicated for a shareholder than it is for a business owner who operates as a sole trader or in a partnership. This is because the director of a private limited company has to legally transfer money to you in the form of a salary or dividend payment. Also, operating as a private limited company has greater admin costs and increased legal requirements in comparison to sole traders and partnerships. In addition to this, legally the company has to publicly disclose key information which not all owners would want to share willingly.